What's going on, you guys? This is Aaron from Departures Capital Analysis, and welcome to Wednesday's analysis video. So I wanted to do something a little bit different in this video. I'm actually going to analyze a dividend ETF, one of my favorite dividend ETFs, and it's got a lot of great companies in here. So we're not going to dive super deep into each individual company, but we are going to talk about the ETF, about the exposure to different sectors, and why I think, it's still one of the best ETFs out there on the market today. I'm a big utility bull. Also, this is not financial advice as well. I always have to say that. I'm just giving my opinion on something, and I haven't been compensated for any of this. However, I wish, I could pick up some utility companies as clients, but I don't really think that they need much exposure. So before we get started, guys, last but not least, you know the drill. If you do support this new channel, kindly smash that like button. It means the world to me, and it helps my videos so very much, along with hitting that subscribe button and the bell for notifications on future videos. Drop me some comments down below. Let me know your thoughts. Also, let me know what you would like to see for future videos. And holy smokes, I realized, guys, we're over 300 subscribers now for this channel. So that is pretty awesome. So we're going to quickly just jump to this video and see what you guys said. 2 comments. Great video outlining the company. I'm a Hive holder of their stock and believe in them long term. Lots of growth, major partnerships. That was for tokens.com. Sticking with WonderFi, bought the dip today at 90 cents. So my Coinbase, I might buy it back after today's pullback and repeat. Hopefully WonderFi can get going. Again, I'll be a buyer at 90 cents or below. As for the metaverse, I am investing in Facebook. Have also been adding to Field Trip. So thanks for the comments, guys. Hopefully we can get more comments. We can keep this going. But in this video, like I said, we're going to be taking a look at iShares S&P 500 Cap Utilities Index ETF, or XUT.TO. So first, I wanted to take a look at the actual stock. So net assets, 280 million. So it's a fairly big ETF with 70,000 shares traded per day. Shares are going for $32 per share, almost 33. So that's a fairly decent amount of volume. It's nothing crazy, but it's enough liquidity. 52-week range of 29 to 33. So the stock is very stable, and that says a lot in this market too, because we've had a crazy bumpy market, and this thing has just performed like no tomorrow. If anything, the volatility has helped this company and the price of energy and all that stuff. So we're going to take a look at BlackRock's website, because this is a BlackRock ETF. For anyone who doesn't know, BlackRock's the world's largest fund manager, I believe. So growth of hypothetical $10,000. So look at this, guys. Holy smokes. What a beautiful chart. I wish that my stocks look like that, but in fact they look kind of the opposite, because I'm a high-risk growth investor. So let's take a look at the 10-year returns. So that's the thing. So the 10-year returns are going to be nothing like, a high volatility growth stock, but with growth stocks in a bad environment, you can get completely hammered, decimated, whatever you want to say, down 60, 70, 80%, 90% for some growth stocks. But those are the risks that you take. And 1-year returns, total return, 12.6% benchmark return. I believe the benchmark is, so index performance returns don't include any management fees. So in a sense, it's underperformed the indexes, pretty much right on par for the most part. But in this environment, if you bought this at the start of the year, you would have dramatically outperformed so many other stocks. So it was put together in 2011, so it's been around for a while, and it's traded on the TSX, which is great. 285 million in assets. They rebalance it quarterly. So that means whether it be selling one, buying another, there is an active portfolio manager when it comes to that. 16 holdings in total. Now, this is also a dividend-paying ETF. Price-to-book ratio of 2.1, which is pretty awesome. Price-to-earnings ratio 30.6, so the PE is relatively high. Distribution yield of 3.17%. So that is your yearly dividend. Now, 12-month trailing yield of 3%. And also wanted to mention here that there is an MER. So an MER is a management expense ratio. Simply just search that up. And the management expense Ratio is 0.61%, so that includes everything. The management fee, 0.55%, and it says medium risk here, but I beg to differ unless you're throwing in bonds into the equation or cash or certain things like that. So an ETF like this is a great starting point for a dividend investor. Now this is focused on the utility sector, which I've always been a big bull when it comes to, just as the businesses are so stable and so essential for a country. Just looking at these companies here, these are primarily Canadian companies, but we've got Hydro One. It's a hydroelectric producer. Algonquin Power and Utilities, a utility company that also has exposure to green energy. EMERA, Brookfield Infrastructure Partners, once again, another utility company. FORTIS supplies a lot of power out west. So we're going to dive into these top 10 holdings. Looking a little bit further here, we can see that 38% are electric utilities, 31% multi-utilities. It's got decent exposure to renewable energy, which I do like. That adds a little bit of, government incentive along with growth potential. We've got a little bit of exposure to gas, independent power producers, and energy, and then cash or derivatives of just 0.11%. So not too much cash. So guys, sorry I lied. We're actually going to look at the top 5 holdings because that equates for 27, 38, 46, roughly 55% of roughly 55% or more of the holdings. So you can see all the holdings right there if you do want to download that. Another thing I wanted to say before we dive into each individual company is, ETFs are a great starting point, but if I personally was, let's say, putting together my own dividend portfolio, I'd probably take the top 5 to 10 holdings and just buy them individually, just because you can save like 0.61% per year in terms of dividends, which is actually quite substantial. But if you do seek comfort in having someone actively rebalancing the fund, then that's totally understandable. But you do at the end of the day pay for that. So let's take a look at Algonquin. Sustainable energy and water for life. We are proud to establish goal of net zero by 2050. So a couple quick details when it comes to Algonquin. So 10 plus historical dividend. So Algonquin, just a couple quick facts. 10% historical dividend per share compound annual growth rate. 101% cumulative 5-year total shareholder return. That is 5-year. $12.4 billion capex plan for 2022 through the end of 2026. 4 gigawatts of renewables in operation and under construction. So they do have fair exposure to renewable energy, which is pretty cool. I definitely like that, and that's where things are going. Then we have some statistics for EMERA. So 22 billion, that's the 2021 average rate base. $8.4 to $9.4 billion 3-year capital program, 7 to 8% rate base growth through 2024, and 39% reduction in CO2 emissions since 2005. So business by region, they've got a tremendous exposure to Florida, decent exposure to Atlantic Canada, and then 8% other. They are mainly electric utilities, which I do like, and then gas utilities, 16%. Moving on to Hydro One. So Hydro One is Ontario's largest electricity transmission and distribution service provider. We distribute electricity across Ontario to nearly 1.4 million predominantly rural customers, or approximately 26% of the total number of customers in Ontario. Hydro One stock has been one of the top performing stocks this year. Over the past 5 years, I was lucky enough to pick some of this up for my dad for his retirement portfolio. I remember below 19 bucks. And boy, do I wish I picked some up for myself, because this thing has just been tremendous performer. It's approaching 100% return plus that dividend. So it's just been an awesome time for these stable, profitable, revenue generating businesses that are just so essential to every country, province. In my opinion, you just don't get any more stable than a utility company, and that's why they're defensive as well. So then we have Brookfield Infrastructure Partners, is one of the largest owners and operators of critical global infrastructure networks, which facilitate the movement of storage of energy, water, freight, passengers, and data. We are one of the few pure play publicly traded global infrastructure vehicles that invest in premier infrastructure assets, stable cash flows, high margins, and strong growth prospects. So I remember doing a ton of research on this company a year or so ago, and they have an awesome track record of growth, as we can see here, 2009 to 2021, per unit FFO, 15% compound annual growth rate per unit distribution, 10% compound annual growth rate. And a couple quick facts. So they've got lots of analyst coverage. And the thing I like about them is the fact that they are international. So they've got utilities, transport, data, and midstream utilities. Counterparty diversification. So 10% data, 29% utilities, 31% transport, and midstream 30%. 514 million fully diluted units, 32 billion in market cap, 5 to 9% target distribution growth annually, 3.6% yield. That equates to $2.16 per unit distribution and 60 to 70% of FFO target payout ratio. So if you're looking for more of a global play, Brookfield Infrastructure Partners definitely looks like the one compared to the four that we've analyzed. And now we're going to take a quick look at FORTIS. So FORTIS has, awesome dividend growth. 6% average annual dividend growth guidance to 2025. So 48 years of consecutive dividend increases. 20 years of superior growth returns. 31 billion 2021 mid-year rate base. 48 years of consecutive dividend growth. FORTIS has its origins in the formation of St. John's Electric Light Company in 1885 in the province known as Newfoundland and Labrador. FORTIS was incorporated in 1987 with just 390 million in assets. Today, our diverse affiliated companies include 10 affiliated electric and gas operations with 58 billion in assets, serving over 3 million customers in Canada, the US, and the Caribbean. Looking ahead, FORTIS will continue to expand and diversify while delivering safe, reliable, cost-effective energy service. So here we go, guys. The biggest chunk of their business, ITC. Then we've got UNS Energy. Fortis BC is a fair chunk, 18%. Fortis Alberta in the purple there at 9%. Then we've got Central Hudson, New York at 8%. Eastern Canada at 5%. Caribbean, 3%. And 1% energy infrastructure. So some decent exposure, primarily North America though. But the thing I like about Fortis the most is the fact that they've consistently grown that dividend, and they've got such an impressive track record of dividend growth along with dividend growth guidance. So it's just very impressive. Even in 2008, we can see here, it's grown. Going back to this ETF, taking a look at the charts, it's pretty obvious, this stock has performed, or this ETF has performed very, very well, especially in times of uncertainty. The thing is, in times of uncertainty, growth stocks get hit so tremendously because they're not generating much revenue or no revenue at all, maybe. They don't know where the next financing is going to come from, at what price. There's so many uncertainties. So investors flock to ETFs like this. So this has always been one of my favorite ones because of its focus on electric power, green energy, and decent diversification, along with a fairly decently low management expense ratio, because mutual funds, so outdated. I know not many people use mutual funds anymore, but those carried 2 to 3% management expense ratio, which doesn't make sense because the yield is only a couple percent. Now it says here the yield is 4.31%. I went on BlackRock and it said that it was 3.17% as of April 14th, 2022. So that information might be wrong, but overall you're still getting around 2.5% in a relatively safe investment that's performed pretty well so far. But in my personal opinion, I like this one, but if it was up to me and I was putting together a dividend portfolio, like I said, I would probably just go out and buy equally, or even if you want to weight it, let's say you've got $10,000 that you want to put into dividend stocks. If you really want to copy how these guys are doing it, 20% of that goes into Fortis, 17% of that goes into Brookfield, and so on. $300 into Canadian Utilities, $326 into Capital Power. You can do this with apps like WealthSimple. Of course, making those small trades doesn't really make sense if you're using a more expensive broker. But a lot of the platforms are going towards no fee, or fee per share, things like that. I still pay $9.95 per trade, so it only makes sense if I trade a couple grand at a time, which I'm okay with. But yeah, guys, that's my opinion. When it comes to dividend stocks right now in this market, I've always been a big fan of the utility companies. I'm still a big fan of the utility companies. And I do one day want to assemble a dividend growth portfolio. Utility companies will be the foundation of that. So I look forward to doing that one day. But for now, I want to see some performance with growth stocks. I know it's been a tough ride, but I wanted to switch it up. So let me know your thoughts. Like I said, I do really like this sector. So we'll see how it goes, guys. Best of luck, and we'll see you in our next video. If you like these videos, kindly hit that subscribe button and the bell for notifications. Drop us a comment down below. We'd love to hear from you. And finally, always remember, Departures Capital is for information, education, and entertainment purposes only. Don't buy or sell a stock because you heard it on here. Buy or sell a stock because you've done your research, you've done your thorough due diligence, and you're making your own personal investment decisions for yourself. This video is not financial advice. Furthermore, this video may or may not have been sponsored by the companies that we've profiled within this video, and we may or may not own shares of any of the profiled companies in this video. If you want to know the full disclosure details, check the description down below, along with thoroughly reading our disclaimer. Thanks so much for watching, guys, and I look forward to seeing you in our next video.